Hello, Ein. I like the look. Hello, little Ein.
There we go.
All right.
Oh no, now my is it? I guess it's all right.
I see
Sometimes
you.
my
Yeah, you look great.
all right. Sometimes my camera video card gets delayed and I got to reboot. So it is a little slow. You want me to reboot real fast, or
Go
are people
for it.
waiting?
Yeah, go for it. We usually wait for 5 minutes for people to join anyway.
Um, I don't know. It seems all right. Seems okay.
It's up to you.
All
You'll
right. I
probably
think
be
we're good.
sharing your screen most of the time.
Perfect. Yep. I think we're good. Yeah. So I have these slides that I had already used. I mean, they're fairly fresh, but I think they'll work well for this.
Okay. I know that there's several conferences that are going on. The Beyond Multifamily Conference is virtually going on right now.
Okay.
I've been in
Yep.
that fair amount. I'm actually going to be a speaker on it in it tomorrow.
Okay. Nice.
Excuse
This
me.
was a virtual conference that I used these for, but called the Cash Flow Expo.
Oh yeah.
And then
I've heard of it, but I haven't attended. How is it?
yeah, it's pretty good. It's largely mortgage note focused because that's what the Fred and Tracy who put it on. They're really big in like seller finance, creating notes and buying mortgage notes in that space. They've been doing it since before COVID, like since, I mean, before everything went virtual, they were doing this virtual conference and it worked well. And then it's free, to attend that, but then if you want to keep everything after 48 hours, you got to pay something. But
Right.
it's pretty good. And then I went to another conference in Nashville last month, which was also for mortgage notes specifically. That's called the Diversified Mortgage Expo. So um,
Sounds professional.
yeah.
Well, we have a tight group here. We've been getting around 50 people or so per Friday.
Okay. Great.
But I'm also, I don't know if I'm relieved or worried about the little stunt that I did last week where um, I made the decision to just email the previous speakers to see who wanted to speak.
Uh-huh. Yeah.
And I got about 90, 80, 90 responses.
Really?
So, so yeah, I was actually going to check our calendar now. We're now solidly booked. You were the one that grabbed this Friday, though.
Yeah.
I probably had 30 people ask for it.
Really? Wow.
Yeah, yeah.
Yeah.
Quite
I
a few
mean,
that wrote me and said that they couldn't make this Friday, but they'd book for another.
right.
Let me look at the schedule here. And for those of you who are, looking at the Alternative Investing Club website, I will be putting them all up there. They're not there yet. I have this week's and next week's up. But as of right now, we are booked all the way through. Our next open or non-slotted Friday is still going, still going. February 6th, 2026.
Wow. Wow. It's a pretty effective email.
Yeah, that worked well. So thank you for to the person in here that actually suggested last week that I email all the previous speakers. We're going to be going through and I got the ones that I thought were the best in the group and gave a large blast email out. And all of them are educational talks, so we're not going to be coming there. There aren't going to be. I think we have one pitch talk scheduled so far this year. So as by the vote that we had last week in this club, we're going to keep it focused on education and in all types of real estate education. And today we have Jamie Bateman. And Jamie, let me. I know you gave me your bio sheet here.
Yep.
So for those of you who don't know, Jamie was a previous speaker at this club, but he's based out of Maryland. He's a U.S. Army combat veteran and part of the Civilian Defense Force, the Department of Defense Civilian. Jamie, I want you to introduce your podcast and your business because nobody introduces a person's business like themselves, particularly when
Sure,
there's a passion for it. And just know that we're going to have people joining us over the next few minutes here. People
sure.
usually tend to arrive by about five after.
Got it. Um, yeah, so Jamie Bateman, I've been an active real estate investor since 2010. And about 5 years after that, I really started to kind of focus heavily on real estate investing. So for the first 5 years, I was a very passive rental property investor. And then just like a lot of people can probably relate to, I had a W-2 and it was fine. It was good, paid the bills, had good benefits. But I found myself, I guess, just it was sort of Groundhog Day, and it was just same thing over and over. And I grew tired of it. So I went part time at the Department of Defense for 7 years. I worked part time, and I was able to start my real estate business. So um, started with rental property investing, and then pivoted in 2018. I shouldn't say pivot, but I pivoted my focus to mortgage note investing. And so we buy mortgage notes, first lien mortgage notes. Um, and I still have my rental properties as well. And I've also invested along the way passively in a lot of other deals. Um, so our primary focus is mortgage note investing, and we're going to get into the weeds on that a little bit. Um, my podcast is called From Adversity to Abundance. The way that came about, I was a co-host on a mortgage note investing podcast for almost 2 years. It was great. I learned a lot. It got me out of my shell a little bit, and I was able to then parlay that experience into creating my own show, which is called From Adversity to Abundance. My show focuses It is for real estate investors. It is pretty heavily focused on real estate investing, but it also is really focused on the human element. And so we don't get really into the weeds of how to do a deal or the mechanics of investing. We talk about a lot of personal stuff. Our guests are pretty vulnerable, and we share lessons from someone's story on how they were able to overcome adversity. That can come in many different fashions and forms, of course. Um, we do keep it somewhat focused on investing, and a lot of times it's financial adversity that they've overcome. And so we do also add practical value. It's not just inspiration on the podcast. So From Adversity to Abundance is my podcast. Been doing that for 3 years. It is somewhat of a passion project, as you kind of alluded to, Daniel. And I do really enjoy it. And hopefully it adds value to others. But as far as the core of my business, we provide solutions for both the passive and active mortgage note investor. That's really what we do. My primary business, the name is Labrador Lending. Happy to go into more detail on anything I just glossed over.
Do you have a Labrador?
Yes, and we lived on Labrador Lane, and so it just kind of made sense.
Okay. I was thinking that would be more likely than you founded it in Labrador.
No, right. That's no. We have a Labrador, chocolate
Oh,
lab. His name is Blue.
all right. I guess this is kind of a curiosity for me, but there are a lot of podcasts out there. What's the benefit that you find out of doing your podcast? Why do you do it?
Yeah. Yeah. So it's a really, it's actually a question that's on my mind a lot right now. And frankly, I'm going to be taking a break. I haven't actually put this out yet, but I'm going to take a break for the summer, which is the first time I've done anything like that. So it does, frankly, I don't want to say it wears on you, but it's a lot of work to maintain that. And
Yeah.
as you mentioned, there are so many podcasts out there. It is very hard to compete. Um, I think there are 4 million some podcasts. Not most of those are not actively putting out episodes, but um, and why I do it really because I learned so much from podcasts myself, and I love listening to podcasts. And it really is a way to add value. The whole one to many, kind of like we're doing today, where one or two people are talking and hopefully adding value to more than those one or two. But also, frankly, I learn a ton, and I expand my own network. I'm connected to all the guests I've had on the show now in some way. and they're at least, somewhat of a warm lead, if you will, or, I have had many follow-up calls and different conversations. And I do think I've gotten some business from the podcast, but dollar wise, it's probably pretty small compared to the amount of time I've put into the show, frankly. So it's a bit of a passion project. I do recently, I heard probably within the last week, I've heard two people who reached out to me who just out of the blue said, I love your podcast. It's just added so much value. It's really been an inspiration for me. I've had people email me, your podcast is like the thing that kind of got me out of a dark place. I'm like, well, that's pretty awesome.
Yeah, yeah.
So there are several benefits, but not gonna lie, it's a little bit of a labor of love.
Yeah, I agree. And that's one of the reasons why we do this here too. It's just so we can bring great speakers in and learn from them every week.
Sure.
And I do it very informally. I don't have any intro music, any outro music to
Yeah.
something like
Oh,
this.
that's
It's
good.
just put up onto YouTube and
Yeah.
and the learning is what it is.
Yeah,
And so,
I also do a monthly broadcast, and I don't host it, but that's got a lot of the bells and whistles and things. And quite honestly, I'm not sure we need all that.
right,
You
right.
know,
Well, let's dig into your topic here, and looks like we've got kind of a smaller group today.
sure.
So feel free to take yourself off mute when we call for questions. We could do it that way, or if you're not comfortable doing that, you can always put your question in the chat as well. So let's talk about mortgage note investing, and you know, I'll let you pull your presentation up. But I
Sure.
guess, are you a strategic? Do you have high level mortgage note investment strategies like you put down so much cash and then you sell the back end of the note, or is it mainly that just you're accumulating a portfolio of performing loans? What's your take on it? How active and how passive, how creative do you get?
So, uh, and I actually think the presentation will address that really well, to be honest
Okay.
with you. No, it's fine. I mean, it's such a big question that so I'm a very active mortgage note investor. We focus on first lien mortgage notes, but I've scaled in multiple different ways. It's still a fairly small business, but I've done joint ventures, like deal level joint ventures, and then I've done partials or hypothecations. They are different, but I've done what you said, which is buy the note and then sell some of that note, to someone else to kind of recapitalize a little bit and go out and buy more notes. I've run a non-performing note fund that was a 3-year fund that's closed now, and that's a good bit of work. And we're going to get into some of this, but currently, and this is not a plug, I'm not pushing it, but currently my focus is the Integrity Income Fund, which is um, it is a reperforming note fund, but we also purchase a non-performing notes and strong performing notes as well. So there's a blend of asset types within the fund. And so we raise capital from passive investors who want to earn a monthly return, and we go out and purchase mortgage notes. So um, there is a lot of strategy to it, and there's always like you either have too much capital or too many deals. It's one or the other, or not enough of however you want to look at it. Um, and so, yeah, I've scaled in that way. I found that for bookkeeping purposes and for communication purposes and marketing purposes, going to the fund model was just more streamlined.
Hmm. I imagine there's a lot of networking that you have to do with these types of activities too.
For sure. I mean, I actually find that personally, my wheelhouse is more asset management and portfolio management. You know, raising capital is not something that I was really trained in or anything like that. And
Hmm.
so it is a matter of uh, slowly gaining trust from people. And the biggest source of our funds, frankly, is from repeat investors who are satisfied and they want to put more capital in. But it's a good bit of networking involved, and that's for both reasons. One is to find more deals, make transactions happen on the asset side, buying and selling of notes, but also for the capital side, raising capital,
Hmm.
and just for you know education, my own education, right? So uh,
Let
100% it's a relationship based industry, just like real estate at large largely is, or can be in many cases. And so networking is huge.
All right, let's dive into your presentation.
All right. I will see, hopefully.
Are you sharing your screen?
Not yet.
Oh,
Just about to. There
okay. I didn't know if you wanted me
we
to
go.
do it.
Will this work? I'll just keep it in
That's
this.
fine,
Okay.
unless somebody in the audience objects.
Um, all right. So I did have these. We didn't have a ton of heads up. I was able to get on here within a few days, couple days notice. So, which is great for me. The timing worked great for me. So thank you, Daniel, for reaching out. I appreciate that.
Well,
Um,
thank you for taking the slot. We had another Friday that was open, and for those of you who just joined, we are now booked solidly all the way into next February, with the exception of 2 weeks in December and after Thanksgiving.
yeah, that's awesome. Um, so these slides I did use for a prior presentation, but they're very, very applicable here. And so the reason I did these, just quick context, the reason I'm giving this presentation really is there are a lot of gurus, out there saying that, mortgage note investing and other forms of real estate investing is 100% passive. And, there's just, it's very easy. Just buy a bunch of mortgage notes and your cash flow is amazing and you don't have to do any work and no legal hurdles or anything like that and no compliance issues or anything. So that's not really the case. And so what I dive into in this presentation, we're going to talk about is mortgage note investing passive. And the other thing that I want to mention briefly is, we like to think a lot of times in, black and white or two buckets, and it's either passive or active. And it's like, well, maybe there's a little bit of in between. Um, is for the audience, do you think I should touch on what is mortgage note investing first?
Yeah, I know that we do have a number of new people in this group, so it
Okay,
might be good to start, with
sure.
the basics.
Just briefly, you know, uh, if anyone has a mortgage, probably many of us do. You may have seen your mortgage lender may have changed over the years. So you have a mortgage, you're making payments, and then you get a notification that, oh, now you need to make your payments to this lender or this servicer. That's when someone purchased that debt. So um, instead of purchasing the property, we actually buy the debt. So in many cases, we're buying defaulted debt, and or reperforming debt there where the borrower had stopped paying for a while and then they start paying again. So um, it's from a high level standpoint, we become quote unquote the bank. I'm not a bank, but we step into the shoes of the lender. We don't, in my business, we don't originate a lot. We have originated a little bit of loans, a few loans, but that's not really our wheelhouse. We purchase mortgages that were previously originated, and we purchase those at a discount. And so we step into the shoes of the lender or the bank. And so now the borrower or the homeowner owes us the rest of that debt. Um, and so there are many advantages. We're not going to get into all the pros and cons of mortgage note investing. There are both. One pro is you can do this from anywhere. One con, I'll give you a con of mortgage note investing compared to real estate rental property investing. There are really no inherent tax benefits to mortgage note investing. Um, so it's a pro and a con I'm just throwing out there. But so instead of buying the property, we purchase the debt. Sometimes we do end up with the property, but that's not necessarily our goal in our business model. Daniel, any questions on that before I?
How often do you think you end up with the property? So in that particular case, what would happen is somebody would completely default on your loan on the loan, and you would be
Right.
forced to take them through a foreclosure process at the court, and
Yeah.
you would be granted title to the house.
Yeah. So there are only broadly speaking, there are only two ways to exit a note other than selling the note. I'm not talking about selling a note but other than that, it's you either exit through the borrower or the property. And when I say through the borrower, that means you're working out something. So a modification, change of terms, something where you get that loan reperforming, where the borrower is paying again, and maybe you sell the note after that. But if you exit through the property, like you mentioned, Daniel, you're either going to do typically you're either going to do a foreclosure or a deed in lieu of foreclosure, which that's where you're getting the deed prior to a foreclosure, which often has benefits for both parties, the note owner, the lender, and the borrower. And so sometimes we're buying, we sometimes buy vacant, uh, you know, vacant debt on vacant homes where the borrower is deceased. And we I don't want to go into this too much because we can spend hours on this particular topic, but you're not going to work something out through the borrower in that case. They're not alive any longer. So you're
What about
going
their
through,
heirs?
yeah, there. So that is an issue. I mean, it can be either an opportunity or a problem depending on, how you look at it. But that is oftentimes you do have to deal with their heirs. I've done a deed in lieu through the heirs in that case, and I've also foreclosed, and it's typically a little bit easier to foreclose because it's not going to be contested probably, although there may be probate issues, et cetera. But and different mortgage note investors have different strategies. Okay, there are many mortgage note investors who that's their goal. That's their business model, is to take the property back. In our case, we will take the property back, and we absolutely will foreclose. And we if typically speaking, if you're 60 days delinquent, we set the loan for reinstatement only. You need to reinstate. And if you're 90 days delinquent, we're sending a demand letter and we're starting the legal process. However, we're trying to work something out with the borrower. The real point is to get them to the table and have communication with us so that we can work something out. And typically we're buying at a discount so that we have some wiggle room to be able to modify the loan or do something, maybe it's a trial payment plan, or for forbearance where we're not going to foreclose for a period of time, and then we work something out with the borrower. It is often more profitable to work through the borrower versus foreclosing. One misconception is, that the equity is yours as the lender. If you do foreclose or get a deed in lieu, no. I mean, that's you're entitled to your full legal payoff that you're entitled to, that was owed to you, which may include arrears and legal fees, et cetera. But you're not just granted the equity on the home unless that you get a deed in lieu that has equity, but that's just not going to happen. Why would someone do that? In today's market, in today's environment, what we're seeing is a lot more bankruptcies in those cases because there's equity in the home. If they can't afford the property, they either need to sell the property, which has been tough with mortgage rates where they are, et cetera, um, or they need to file for bankruptcy typically. So, um, again, we will foreclose and we do take back properties and we do deeds in lieu as well. But I've ultimately, I'd much rather work something out with the borrower, and then it becomes a win-win situation,
What
and it's more profitable as well.
what advice can you give to a person who's unable to pay their mortgage and is looking at
Yeah.
potentially losing the house?
It's a great question. The first thing is don't ignore the problem. It's not going to go away. So communicate. I mean, you just don't hide from it. Things, bad things happen to good people all the time. Um, People lose their jobs. Health issues arise, divorces happen, et cetera. Um, that happens to, we all deal with things like that, right? And so don't just pretend it's not happening. And so the biggest thing is just communicate. And you know, you also can seek out. Some states still have financial assistance, that may be able to help get you back on track. But the biggest thing is communicate. Don't dodge, the lender, because then they're left with really no other alternative but to foreclose.
All right, I'll let you go ahead and start the presentation. I'm sure
Okay.
we could just keep on talking, but
All right. So is mortgage note investing actually passive? And you can see my screen okay? Awesome. just quick disclaimer, none of this is legal or financial advice. As Daniel said, this is for educational purposes. I will have one slide with at the end with contact information. I did mention our fund. We also have solutions for the more active note investor. And so, but ultimately, this presentation is for educational purposes only. I'm not going to read this to you. It's a little bit about me. We talked about this some. You can go to our website, labradorlending.com, if you want to read more about me. I also did put a book out, which is called From Adversity to Abundance. I'll mention that. But, the spectrum of passiveness in note investing. So you can read the slide. Ultimately, I'm giving the answer up front here. Is mortgage note investing passive? Well, it depends. It can be. And I just personally don't love it when people say, well, that's passive, or even rental property investing. I mean, in my case, rental property investing for me is much more passive than my mortgage note investing. So we're going to get into, the biggest thing we're going to get into here is it can be mortgage note investing can be passive, and how can, and we're going to show ways that passive investors can work with active investors. So it's really a spectrum, just like many other things in life are. And it's not black and white. And so ultimately, understanding your goals, your experience, and your risk tolerance is critical. There are many options within mortgage note investing, such as first lien mortgage notes, second lien mortgage notes. There's also unsecured debt, which would not be a mortgage note, but there's other debt you can buy. And then there are many ways to kind of slice and dice your approach to which types of mortgage notes you're going to buy. Oftentimes that actually falls back to uh, geographic differences, because each state is very different with regard to foreclosure laws, and we could spend all day talking about judicial versus non-judicial foreclosures, et cetera. So the reason I'm going to the weeds a little bit on that is about portfolio diversification. There are many types of assets or types of notes that you can buy as a mortgage note investor. And then side hustle opportunity, you can do this on the side for sure. Is that your objective, or do you want to scale this as a business? What is your situation? Do you have time? Do you have capital? Do you have energy? Are you looking for a job? What are you looking for? So, and scaling your note business, there are many ways to scale, and that's what we're going to talk about here, is how different ways that the active note investors can scale. And that really ends up pointing you toward the more passive investor, working where the active investor works with the passive investor. I mentor active note investors. The reason I say that is our program is tailored, and again, it's not a pitch, but I know this from experience, is that everyone's situation is different. Okay. So your skill set, your experience, and your goals are different from the person next to you. And so we don't have a one size fits all program for that reason, because each person's objectives and experiences are different. We have a lot of, in this space, we have a lot of engineers, we have a lot of real estate investors. And yes, this is real estate investing, but I mean more traditional real estate investors. We have people from all walks of life getting into the mortgage note space, and they have different goals as well, and there are different phases in life. So just understanding that is critical.
Hey Jamie, I was going to say, don't hesitate to mention your services. So
Okay.
the only reason I caution speakers so much
Yeah.
is I don't want coming in and giving hard sells. But yeah,
It's
feel
not a
free to
pitch
tell us
fest.
all about what you do and what your services are.
Okay. I mean, just briefly, we do one-on-one mortgage note mentorship, and that is really for either the person who's not sure. A lot of times you're not sure. Is this for me? I'm not sure. So we have a 3-session minimum, and you'll work with me or my associate, Shante Duffy, who's very experienced, and both of us typically, but oftentimes you're working with me. But that is for the active investor who wants to learn more about mortgage note investing, how to scale a business on some level, or they just want to buy a handful of notes. But you're buying whole notes, okay? You're not investing in a fund. You're not a passive investor if you're joining my mentorship program. You're interested in rolling up your sleeves a little bit, learning and spending some time buying whole mortgage notes. We also have our fund, the Integrity Income Fund, which I'll talk a little bit more about each of those as we go along. So understanding your risk tolerance, I mean, for some people, they're just, they don't sleep at night if their capital is really at risk. For other people, maybe you're younger and you're fine with putting some capital at risk and taking rolling the dice a little bit. You have more time to recover. Maybe you're just wired differently, right? So understanding your comfort level with risk is critical. And again, I'm talking the reason we're talking about this is just to develop your approach to mortgage note investing, whether you want to take a more passive or active approach, and if you do one or the other, or how that materializes. Um, so for those willing to take on more risk, active note investing can offer higher potential rewards. You could honestly argue that in some cases, passive investing is more risky because you're handing your capital over to someone else. Um, Non-performing notes on paper compared to a performing note, and just to reiterate, a non-performing note is where the borrower is more than 90 days delinquent. Those tend to come with a little more risk because you really don't know how that's going to turn out, and you're not getting cash flow typically. And so that said, you do buy at a greater discount, so your pricing is better. And the bigger thing to understand there too is your goals with, if you're buying non-performing notes, you're not getting cash flow. Do you need income? Because that is not the way to go. Buying non-performing notes is not the way to go if you need income. Do are you okay with getting a payout in 2 years? Then maybe non-performing notes is the way to go. So that's not so much about risk as it is just your goals and your needs for what you're looking for from an investment standpoint. So here, that fourth bullet is about tailoring your strategy to align with your goals and your risk tolerance. Obviously that slide probably relates to not just mortgage notes, but many other asset classes and strategies. So here we really get into a little bit more detail of how you can approach mortgage note investing. And we just called this the spectrum of passiveness. You could call it the spectrum of activeness, I guess. um, but at the top, very passive. Investing in a mortgage note fund. Okay, putting your capital. My note fund, the Integrity Income Fund, is for accredited investors only. It's a 506c. I can talk about it. I can advertise. Um, and you're putting your capital in my fund, and I'm just using it as an example. I'm personally invested in other note funds as well. Um, but you're putting your capital, you're entrusting me and my team to actively manage your capital and go out and buy notes for our fund. It's very passive. Our investors get a monthly distribution. They get a monthly update with what we're doing with their capital and what the fund is up to and performance of the fund. That fund has been going on for 3 years now. That's an extremely passive way to go. You're really not involved. You get a K1 each year. You send that a Schedule K1 for your tax return. Send that to your CPA or do it yourself, and there's some emails or some documents to sign. That's just like investing in a syndication or another type of fund with any other asset class. Um, any questions there? I think that's pretty straightforward.
I don't think we have any questions yet, but
Okay,
from the group here, feel free to put them in the chat if you want.
perfect. Um, okay, so we get into number two here, rather passive. And these are not the only five ways to get into mortgage notes. Um, Rather passive. Okay, so this would be hypothecation or purchasing of partials or partnering in a JV deal. Okay, I'm gonna get into the weeds a little bit on this. So I've done all of these on really on both sides. Trying to think if I don't know if I've actually bought partials, but um, so I've sold a bunch of partials, but so hypothecation is really when you're lending money on a note. So the note itself, and this is a little meta, if you will, the note that I go out and I buy a mortgage note. Okay, I buy a mortgage note for $50,000. Let's just say that, and I want some of that capital back because I need to buy more mortgage notes. Well, as the active investor, I'm looking for a lending partner who's willing to lend me money with that note that I already own as the collateral. Okay, so that's what hypothecation is. It's very similar to partials. Okay, and I have a blog post on my website about the differences between the two, partials and hypothecation. They're very similar. Ultimately, hypothecation for the lender or the person, purchasing, I guess, sending the money to the active note holder. Hypothecation's a little bit more passive for that person. Um, when I was doing hypothecations as the borrower, okay, I was just sending at the end of every month, I would send out my payments to my hypothecation lenders, and via ACH. Took me about 20 minutes each month. It didn't matter whether my actual borrowers, the borrowers on the property, the uh, owners of the property, whether they made the payment to me or not. I borrowed money at X terms, and I'm sending that monthly payment to my lender. What's really cool about hypothecation is there's so many, you can really structure it however you want. So I'll give you a more concrete example. So I started with that one where I bought a note for $50,000, but now I need more money to go out and scale my business because I ran out of money, right? Well, I approached Daniel and I say, Daniel, would you be willing to lend me capital for the next 3 years at 8%? And I'll send you that money each month. Your collateral is the note that I already own. If I default, I stop paying you, you can then actually take back part or all of this note that I own. That's your collateral. So that's hypothecation. And I just want to cover partials, and then if there are questions, then I'll just briefly touch on what a partial is. Purchasing a partial. Okay, so so with a partial, Daniel, you're actually buying 3 years of actual partial payments. And what that means is you own part of that note. So the servicer is involved. Your disbursements are coming from the loan servicer, and that's based on whether the borrower is making their payment or not. The homeowner is making their payment. You're not actually lending money to me. You're actually buying 3 years of payments. So they're very similar. And I mean, we could spend 3 hours on this topic easily. But with purchasing a partial, you, Daniel, in this example, are a little bit more active than when you're lending me money with a hypothecation, because now you've got to manage the borrower, you've got to manage your servicer. If they stop paying, what happens? If the borrower stops paying, you're involved. You're the one who owns that note or that part of the note. And so it's a little bit different. I personally favored the hypothecation model over the partial model, but they're very similar.
Okay, I have a question actually to start it off,
Okay.
and that is with hypothecation. You hit me with a word I didn't know yet, and so I guess from what you're saying, this is the act of putting up something of value, an asset, as collateral against a loan.
Correct. And in
Okay,
this case, it's the mortgage note. Yes,
right. It's not like with the
that is
bank,
the
the
collateral.
collateral is the house.
Right. It's very hard to, I've never heard of a bank. People talk about banks hypothecating. I don't know. I've never seen it myself. It's more of a private thing. So yes, you're right. So the
Oh,
asset, the collateral in this case is the mortgage note itself. It's
does
not the property.
when you're using the word hypothecation, does that specifically mean that it's another note, or could it be any asset that's put up as collateral?
You know
That's
what?
okay. Guess is not important. I'm a grammar nerd.
Yeah, no, it's
Um,
I'm that's in my world, it's another note.
right.
I don't know the answer to
Okay.
that question.
So I guess my question is that you can sign paperwork that says that you're putting up a note as collateral and you're borrowing some money. Is there a third party registry when the bank lends you money against your house? Right, they have to go down to the county
Right,
clerk's office and record it at the recorder's office with
right.
the county recorder.
Yep.
And but if there isn't a third party that records that sort of transaction,
Hmm.
you could take your same note and collateralize it, hypothecate it
Rehypothecate.
against 10
Yeah,
different people. And
so
then if you
true.
go broke and they all come for your asset,
Yeah,
only one of them's going to get it.
it's a great point. The really, to my knowledge, the best way to record anything in that case would be a UCC filing. Which
Yeah.
I have done. Actually, I had an investor, person lending me money who it was quite a bit, relatively speaking, it was a higher dollar. It was actually two hypothecation loans, and we'd never worked together. And so he said, "Would you mind doing a UCC filing or UCC lien um, in this case?" And the paperwork, I said, "No, that's fine. We can do it." And so that there is that. But you're absolutely right, Daniel. It's not typically recorded. There's nothing with the county land records or that's recorded there. So here's what I would say to that. I mean, same thing with a fund. I mean, when you're expecting to make money passively, the operator is critical. Placing trust in me in this case, right, is critical. So you're absolutely right. I mean, I could go and do that, and eventually, I think it comes back around. But
You'd probably get brought up on fraud.
yeah, exactly. So is it possible to do what you said? Absolutely. And
Yeah.
but again, I think my counter to that would be, well, you have to that there's just an element of trust and risk that's involved if you're
Okay.
expecting a passive return, because I'm doing the work and so that's just kind of comes with it. Now, purchasing a partial, there will be more that's on record with regard to your ownership of that typically, and the servicer is made aware, the loan servicer is
Right.
involved, the third party loan servicer is involved in dispersing to you those payments while you own that note. So that's a little more, you could say less risky in that case. Here's one reason I don't like that as um, the whole note owner, if you will, the person who purchased this whole note. Um, I don't know if you're going to manage that well as a more passive investor. What if it defaults and I'm still on the hook for owning the rest of those payments after your partial period is over?
Oh,
I
yeah.
want I don't necessarily trust that some new person is going to manage that well, right? And so I prefer the hypothecation model also because I get to kind of control how things are done in that case, because it's still my note at the end of the day, right? After the whole note is still mine.
Is is there a way to combine the two strategies where you say if you're selling some of the monthly payments, let's say you go to somebody else and they buy the first 10 years worth of payments on a note.
Right.
Could you, sell those off and then, have some sort of collateral agreement where if they default, they put something up for collateral or
It definitely could. I've never done that, but I don't see any, and again, not an attorney, but
okay.
I don't see any reason you couldn't. This is an agreement between two people. Um, yeah,
Okay. All right.
I think it makes
Let's go
sense.
to the questions here. Harsha has a question. What kind of investment is needed to start? What kind of returns are we looking at? I
Mm,
understand it can vary based on passiveness.
sure. I would say it's gotten a little bit higher. So, um, the headline answer I would give is probably 25 to 50K to get in this game. That said, there are ways to get in if you don't have that capital. If, for example, I don't really talk about this in the presentation, but brokering notes is one way to get additional capital. Also, second liens, which have made a little bit of a comeback. Buying defaulted second lien mortgages, if you think about it if you have a HELOC, for example, on your own, property, those are typically a lower dollar amount than your first mortgage, right? So to buy a defaulted second lien mortgage note, you may only need $5,000 or $10,000. And I've bought mortgage notes. I actually bought a mortgage note for $100. Um, but typically speaking, you're going to need probably 25K to really get in this game. And quite honestly, it's a capital intensive game, and that's one of the hangups for people, because it's not like a rental property where you can often get a loan from a bank for 75, 80%, maybe even more, of loan to value, right? Um, so 50K, you got a pretty strong position to start buying maybe a couple of first lien, even performing first lien mortgage notes. We buy in the Midwest, we buy in the Southeast a lot, and so these states, I don't know where everyone's from, but they're not like California, New York. So you can buy a decent property for 150K, even 100K. And so those mortgage notes may have been originally worth, for say $75,000, and now maybe there's $30,000 on the balance because it was originated years ago. You can buy that for 25, even $20,000. So, and just also another way, just briefly, and that's a great point, and I'm glad the question was asked at this point. That's a great way to get into this space. If you don't have that much capital, is to do a hypothecation as the lender, or to buy a partial note where you're only buying 3 years of payments. It could be 2 years, it could be 10 years, but you're going to not need as much capital as you would if you were buying a whole note. So there are ways to get in with less capital, but I'd say 25 to 50K is a good starting point.
Manju is asking, are mortgage notes only targeting single family homes?
There
So
is, yeah.
go ahead.
No, in fact, we've broadened our own buy box in our business, and we've gotten into some more quote unquote commercial paper a little bit. However, that's actually more of the fix and flip debt, which is still on a single family residence. But there's commercial debt you can buy, land notes as well. A lot land notes have made a lot of you may see a lot more. I don't know if you've had land investors on here,
We've had a
but
couple.
okay. So
Go
those are
back,
much
Mark Podolsky,
okay.
and
Yeah.
then we've had Lygia and Mark Denton.
Okay. I know Mark Podolsky fairly well, but that's another way you can get in with less money. I mean, generally speaking, land costs less than a land with a house on it, right? Um, and so no, they're not only on owner occupied houses. In fact, there are pros and cons to not buying owner occupied debt, if you will. One is that there aren't the Dodd-Frank regulations and the state regulations. It's a lot less red tape because it's a business purpose loan. It's not an owner occupied or consumer loan. So um, we our wheelhouse is more of the owner occupied debt. And there are reasons for that. One is it's longer term. And so if I have a performing loan, it's not going to, get paid off necessarily in the next 2 months, and then I got to go put the capital back to work. These are more long-term plays, slow, boring, in the case of the performing owner-occupied note. And also, borrowers are much more motivated to work with you if they're living in the home. That's their home. Whereas, so the default rate on the land notes and commercial notes, at least on the like fix and flip or bridge loans in that case, those default rates are much higher than on the owner occupied side. Um, so the answer is no, it's not only single family residences, but I personally like just that backing of that. I find it to be a solid collateral that's residential real estate, single family real estate. That's what I know. I started in residential single family rental property investing. I'm not afraid to take the property back and fix it up if I have to, So that's the space that I kind of live in.
And Manju, one of the goals of this club, of course, is to get people's creative investment energies going. And so, just know you can lend against any asset. Businesses often do equipment loans.
True,
So the business might, buy some equipment that they need for whatever their business is, and they pay the loan back to the bank. Well, you could be the bank in that case, or car loans, boat loans. There are other smaller dollar values ways to get into it. The only thing
for
is
sure,
you really got to know the industry and the legal implications.
for sure. Um, all right, so I'll pick up the pace a little bit here. So somewhat passive is purchasing performing notes. This is where we're getting more active, less passive. It's somewhat passive. And so this is how I often recommend that a new note investor who has some capital to put to work, how they start out. It is a little more capital intensive than a non-performing note, but it's less work, it's less headache. And so buying a performing note really just means you're buying a mortgage note where the borrower has a strong and long history of making payments. the note is considered performing. They're paying on time for, at least the prior 12 months. Maybe they had a hiccup before, but it's they're paying. Managing that is not that difficult. So it's not that time intensive. You get a loan servicer, they collect the payments, they disperse the funds to you. You have the documents recorded. Um, you can buy a handful of performing notes and probably spend a couple hours a week, maybe even less on your business, if you want to call it a business. um, and so buying performing notes. Now, again, if you're scaling, you're buying 500 performing notes. Well, that's different. That's going to be a lot of work because there is a lot of paperwork in this space and a lot of detail to track. You've got to track taxes and insurance, for example. You want to make sure the property taxes are paid. You've got to make sure the home has hazard insurance on it. So there are things. This is not like purchasing stock shares. This is not like investing in a fund. It is more active than investing in a mortgage note fund. Rather active. We're getting more active here. We have energy. We have time. We want to really put our, dive into this. Purchasing non-performing notes, you're going to have more work. You're going to have to file even if you buy one non-performing note, you've got to manage an attorney, which sometimes is challenging. You've got to get a demand letter out the door. You've got to start the foreclosure process. You've got to decide if the borrower comes to you with a story or, a reason they want to work with you. Are you, what do you want to work with them? What's your, you're kind of in charge there. So there's decision making, there's management of, and if they're defaulting on their mortgage note, they're probably not paying their property taxes. Are you prepared to pay those property taxes? So buying non-performing notes may come with more upside, but it definitely comes with more work than performing notes. Creating notes, this isn't really our wheelhouse, even though the name of my company is Labrador Lending. People create a lot of notes, especially now in the last 5 years. I mean, institutional lending has really tightened up. And so the private sector, the private lending space has really grown quite a bit. Bridge loans, fix and flip loans, owner occupied seller finance debt has really is filling a void for sure. And so creating notes is more active than buying a performing note because you own a property that you need to sell typically, and then you're going to sell on terms. So you're creating those terms, you're creating those documents, you're getting things recorded, and it's a little bit more active. Um, I did gloss over in the rather passive partnering in JVs, and I'll hit that here with the very active, and then we'll kind of there's a couple slides that show how it ties together, where active and passive work together. But a joint venture could be on anything. It could be on a business joint venture. It could be on a real estate, a piece of property. In our case, we're talking about joint ventures in buying a mortgage note. This is a deal level joint venture. And so I've done a bunch of these. I don't do them anymore. What I've personally found to be the best way to approach this is on non-performing notes. And the reason I say that, so typically a joint venture is set up where one person is more of the capital partner. They're more passive, and one person is more active. They're the day-to-day operational manager of that, of that note or that deal. Um, however, both people need to be a little bit active in making decisions together, and this is for legal reasons. It's not a fund. You're not just expecting a passive return as the money partner. The reason I find that joint ventures work best on non-performing notes as opposed to performing notes, and this is learn from my mistakes. I used to do JV deals on performing notes, but the problem was the borrower kept paying and there was no end in sight. And it's like you realize, well, how do I get out of this joint venture deal? Eventually after years, well, they keep paying and there's no end. So it's just so what I ended up realizing is that performing notes work much better for hypothecation and partials. Non-performing notes work much better for joint ventures, in my opinion. And that's because there's a clear exit point in that deal. And we talked earlier about exiting through the borrower or exiting through the sale of the note or exiting through the property. And once that exit occurs, well, the two JV partners split the profits. Hopefully there are profits. And there's a clear exit to that deal. So I found that joint ventures work much better on non-performing loans than they do on performing loans. And then I'll hit managing a fund, and then if there are questions, we can address them. So managing a fund, it's what I do. This is my second fund. The Integrity Income Fund is the second fund that I've managed. I also managed a non-performing note fund for 3 years. Managing the fund takes a good bit of work. I'm managing people's capital. They're entrusting me with their money. I'm managing the assets that we're buying. I'm constantly evaluating new purchases. We're doing due diligence on notes to purchase. We're constantly selling notes. And so there are three parts to managing a fund. And I think I have a slide on this later. But the three are raising capital. Number two is finding deals. And then the third part is managing the capital and the deals. And when I say deals, I mean notes, mortgage notes. Those are really the three legs of the stool. It's the capital raise, so finding capital, investors. The second part is finding notes to buy. And the third part is managing the money and the notes. So it's very active, and there's a lot of paperwork. There's a lot of day-to-day management. You need to be organized and a little bit probably annoying to people. You really need to be pushing and getting answers because attorneys and your servicers and your other vendors are not as invested in your business as you are. So you've got to be active for sure, and communicating as well with your investors. Any questions on that slide?
We do have one question here, and I'll give you the 5-minute warning. We've got 5 minutes left.
All right.
It's not particularly on this slide per se, but what's the risk of losing the principal amount invested in a mortgage note?
Well, I mean, the risk would be I'll address this like this. The way that I've lost the most money on a deal, okay, is if I underestimate the property value, which is, it is a risk, especially because you can't get inside when you're doing due diligence. If it's an owner occupied property, you can't get inside that property typically. So I don't know if it looks good on the outside. I think it's worth 200,000. Maybe there are hoarders in there, and it's worth 75,000, so that's a big way. Or if you don't have insurance, if a tree falls on the house, something like that, where it's really underestimating, or, that property value. That's a critical piece. But if you've got enough equity, it's hard to lose your principal. If you buy right, it's hard to lose your principal. Buy right and properly estimate the property value. You're safer. I'm just going to fly through these since we have very little time, and I've already covered a lot of this, and I'm happy to send these slides as well, Daniel. Mortgage note fund, we talked about that. We go into a good bit of depth here about how mortgage note funds work. And again, my fund is for accredited investors. We talked all about this, so I'm glad we can kind of fly through this. Hypothecation, purchasing of partials, joint venture partner. These are just more rather passive strategies. I do want to get to okay, so yeah, you can see why creating a note is rather active. Purchasing the property, rehabbing the property, finding a buyer, underwriting the loan, selling or holding that note. There's a lot of steps in, assuming this is the model that you follow for creating a note, originating a note. And again, very active would be managing joint venture deals with non-performing loans or managing a fund. And again, there are other ways. This isn't everything. I'm not covering every way to be a note investor on these slides. These are some other considerations, but here's what I want to get to. And this is kind of hard to see. There's another slide that has a different visual. Is mortgage note investing passive? Well, it can be. And the way it can be is if you work with an active investor. So really, if I had to say yes or no, I'd say no, it's not. I'm not swinging a hammer. It's not physically demanding. But there's a lot of detail and you need to be organized and systematic about if you want to be an active note investor. Can you be a note investor passively? Yes, you can invest in a fund. You can see here, if you can see this, it says managing a fund is on the active side, investing in the fund is on the passive side. Managing a joint JV deal on a non-performing loan is on the active side. Being the money partner on a JV deal is on the passive side. So we get, down here, hypothecating, as the borrower is more active. So I'm the active person who holds the note. I already bought the note and I'm borrowing from this passive lender. So you can see here that, if you can see it, that passive investors can work with active investors. Here's another way, just another visual, people can hopefully take some value from. Um, and here's again another way. So ultimately, investing in a fund, you work with someone managing a fund. So um, these are ways, just to quickly cover that we have 7 core services we offer. The primary things we offer are our integrity income fund and our note investing mentorship. So this is for passive investors, accredited investors. This is for the active investor. The mentorship is for the active investor who wants to learn and really, really move quickly in getting into this game. We have a 74-page ebook. It's 5 chapters. It should have been 5 ebooks. It's really a ton of information. I really think it's valuable. We have a lot of other resources on our website, which is labradorlending.com. I flew through that, but that's because I got the 5-minute warning 4 minutes ago.
Well, keep your contact information up there, and I also wanted to make a last minute announcement here, just to say that we need one more person to fill in and be the moderator, not next week, but in 2 weeks. Anita is going to be our moderator next week, and I'm going to be out on vacation with my family, going to my wife's cousin's wedding in Yellowstone. So
Nice.
email me if you don't mind being the person collecting questions and introducing the speaker. And for everybody else, can you guys take yourselves off mute and thank Jamie for coming in and speaking to us today?
Absolutely.
Thank
Thank you,
you,
Jamie.
Jamie.
Very
Thank you,
informative.
Jamie.
Thank you so much. Appreciate it.
Very
Thanks a ton.
informative.
Yeah, you're
There
welcome.
they
Thanks,
are.
Thank you.
Jamie.
Yeah, that was great. Thank you for having me, Daniel. I really appreciate it.
Yeah, thank you for coming in and sharing.
Absolutely. So if
And
anyone has any questions, feel free to reach out. Happy to help.
absolutely. Grab that contact info. Everybody else, next week we're going to have, I need to go look it up. But as I said earlier, our club officially has speakers for every Friday going into February of next year. And next week we have Small Bay Industrial, and whether it is an up and coming sector in the economy. So looking forward to that. Talk to you later.